we're in the small account challenge. So with that being said, I give you Tuesday's DC. What are we looking at here, Matt? What is this DC?
This is a 1-3. So you're selling a Wednesday strike on Tuesday, buying a Friday strike. So this is going to be a DC where the short leg expires 1 DTE. And we're entering it in the morning. And it's the same as yesterday, to where we have a little bit of slippage, some opening fees, and our only exits are time before it would expire and get assigned, and using leg deltas. So those are the exits, and it wins most of the time. And your winners have traditionally, your average winner is traditionally a little bit bigger than your average loser. And because it's part of the SAC, the small account challenge, it's 1 contract per trade. And so here's what's interesting. So yesterday I broke rule and I did some back testing live while we were on the show. And today I did something a little bit different. I ran 10 variations of this back test. And I ran it with the same deltas at 937, 933, 934, 936, 940. And the capture rates were 7.5, 8.1, 8.1, 8.9, 7.7. And then I ran it with different deltas. I did a 20-20, a 25-20, a 23-23, a 15-15, a 25-15, which was the original. And the capture rates were 8%, 8%, 9%, 7.5%, 8.1%, 8.7%. What I don't want you to do is pick out the highest capture rate and say, Matt, which one got this capture rate? Here's the point. That exercise, what I just did, 10 variations on a theme, okay? It is going to the point that this backtest is a good concept. This backtest is actually not curve fitted. There are better deltas and better times. The point is, when you have all these variations, 68% win rate, 60% win rate, 67% win rate, 58% win rate, 63% win rate, 66% win rate, 67, 63, 64, 64, all the different deltas, all the different minutes. What does that say? There's a concept here that's worth spending some time on. And because we have a world-class backtester, you can do that in a couple minutes. But here's the point. This expiration has worked in the past for years. And it's worked without curve fitting a magic minute, without curve fitting a certain delta. As I just mentioned, there are both better deltas and better times if you're that into precision. But the point is that there's something here.
Let's model it out for a second, if that's all right. Because I know with DC, sometimes it can be confusing. So this is the 25 delta put, 15 delta call.
Yes.
DC. And I want you to see this white line is the current price. Let's play it out. And when you see this, first of all, okay, these two kind of big tents or triangles, however you want to do it.
Mountains. My house is between those two hills.
That's right. We live in a holler of death with the DC. That's our fear. And as you play this out through time, you're going to gain value. I'm doing this real slow, but I just want you to keep your eye on the current price. Okay, that white line. What's happening as time's going by? As time's going by, we're still good in value, but the value's going down about right here because we have these break evens that suddenly popped up. These break evens that have suddenly popped up, which is the tent of death, the valley of death.
Sea of death, yeah.
Sea of death, yeah. When you look at this, what you realize with this is you don't need it to go down too much. You need it to go up a little bit, but because it's a trending market, normally we will trend up, right? And I think that's a helpful way to look at it. When you look at the delta of it, this is where it gets a little interesting. You go, okay, your deltas are adjusting through time, right? Where your deltas are going up and then it's forming a line. That's the beauty of options, is that's all math, right?
Yeah.
Okay, how's your theta working in this? Because this is a short-term trade, it's actually hard to model that theta but you're positive theta in general. And then as time goes on, you actually are losing theta if we don't get out of that valley.
Yeah.
And so the whole point with all of that is to say the Greeks are really important in these type of trades, but because it's a short-term trade, they don't have forever to work in your favor one way or another. We needed to move about 10 points to get max profit to the upside.
Yeah.
But here's the beauty of the test, and let's go back. So here's the exit. You are exiting the trade at 230. You're getting out because we have assignment risks. This is not a ride or die. You're getting out to make sure that you don't get hurt and don't get 400,000 shares of Qs.
Yeah.
And then we're using leg deltas. And on the leg deltas, how we're doing this is the 25 delta put, when it goes to 60, above 60 delta, we're getting out. And the call, when we're going below 60, we're going out. So let's go back to this real quick and look at this. So on this, let's go back to delta. When are you getting out? You're getting out near the end. And this isn't going to model it correctly, but that's okay. You're getting out. Basically, these 60 deltas are near the end.
Yeah.
And so you're very rarely going to get out really early in this trade, but it's not a trade that lasts long in either direction. So you're fine with that. Listen, last thing I'll say real quick. We talk about all the time, that's one contract. So you're not accounting for sequence risk. This is what that trade looks like if you do a 100% port. Don't ever do a full 100% port on anything. But to show it off, the point of it, the trade works, right? The trade works for larger size, much larger drawdown, and you have to account for that. But I think it's important to remember there are plenty of tests that only work because it's one contract, and it doesn't work as soon as you get to 3 contracts. This is not one of those trades. You can have confidence in this type of trade. It's not financial advice, but
Yeah.
you have
There's something here to mine. Like there's some good ideas here.
And bottom line is, this is a high probability trade.
Yeah.
It's a high probability trade. And because you're selling, regardless of the deltas, you're selling somewhere between a 15 and a 25. So you're getting high probability trade. You have a lot of room. Just because you have high probability, as long as you have decent rails on so you don't screw it up. If you have decent rails on and rails just appropriate that you don't get too far past the shorts, that too far, it's going to work. I don't think people appreciate having those kind of, I call it professional risk management rails that can help you lock in that you've got a very high probability rate and get out. And I like it because that's really the whole problem in DCs is if it moves too far. Yes, volatility can be a problem, but I'm always going to be more worried about the price risk.
Guys, good trading.
Okay.
All right, guys, have a good week.